A warm good evening to the members present for the latest updates for ITR filing. We have CA Kaushik Raj for handling the session. I request CA Kumar to escort the speaker onto the dais and welcome him with a floral bouquet. Thank you, sir. I have the privilege of introducing today's speaker, CA Kaushik Raj. Kaushik is a fellow member of ICAI, IBBI registered valuer for asset class SFA and has graduated in commerce from St. Joseph College of Commerce. He has a strong passion for direct tax and has been regularly taking classes for students of company secretary and chartered accountancy course. He is a partner at Kaushik and Shivram Chartered Accountants, leading the direct tax, business process solution and valuation consultancy of the firm. He is an active speaker in many forums. He has experience in structuring of various companies, right from incorporation to funding. With this brief introduction, I present before you CA Kaushik Raj. Over to you, Kaushik.
So good evening, everybody. So let's see what is the hottest topic for this month. So we are already beginning of this month, July. So July 31st is the ITR season filing. Starts with the individuals or the non-audit cases and then goes till October and November. So we'll see what are the recent updates and modified contents in the ITR in the recent time, which is applicable for assessment year 23-24. Before that, let us see what is the revolution. I think we all might be knowing from the era where we were seeing the Saral ITRs, where the paper returns were there, where there was not even having any computerized or digital forum. From there, we have been traveled today to the software-based or the online filled ITRs kind of era. Earlier, if you see, there was not even the year column was left blank, wherein somebody can print or the forum can be print. In the same forum could have been used for multiple years, just like the assessment year 1998, 99, then 2000, 2001. Up until 2005-6 it was, or 2001-2 it was the paper return kind of thing. We could always use the same forum. But now I think there are different forums and different ITRs. Every year there is a change in the ITR forum, and this is all online enabled forum for us to validate and do all these things. So that is one thing that we'll have to see. With added thing from the Finance Act 2020, we have the Finance Minister who has told that all the citizens of India or the taxpayers of India that the data which will be pre-filled and will be filled automatically into the ITRs, through which they have introduced the concept called the annual information statement in place of Form 26As, or parallelly along with Form 26As, we have annual information statement also. So this ITR landscape, we all know that the technology based, it is now going towards the technology based, because we have certain parameters to validate through different information fields. Like for salary we have Form 16, like for other heads of income there will be TDS returns, or there are different sources of income which will get financial transactions through SFTs, all of that being coming through the different channels, or in case of indirect tax, there are turnover being matched with the income tax turnovers. So this is the era of matching with different sources, whether the data which is flowing into the ITR is being correct and appropriate and accurate. So which all these three has to be focused while preparing the ITR. Because of this, there are a lot of automated notices being coming in. Earlier, that was also possible, I think, but it was through manual verification system. That means somebody has to sit and check whether the turnover as per VAT return and turnover as per income tax return is same or not. If somebody can check and then send the notice, it used to take humongous time, or it was taking a large amount of time. But now it is happening through a click of a button or through an exceptional reports, automated emails and automated triggers, automated communication system. So this is the tech-based processing system that is happening through. So moving to AIS and TIS, what we need to take care in while filing the ITRs. So there were two era of AIS and TIS. The first is Finance Act 2020 when it was introduced, and again the new AIS was introduced where they told that there are a lot of improvements that they felt they need to take through, because to AIS we have information sources coming in through from, one is the 285 or 114 rule, where the information comes from the annual information statement filers, that is through various SFT, that is statement of financial transactions. Also through the TDS returns through 24Q, 26Q, 27Q and 27EQ. So there are two sets of transactions. There were repetitive transactions, so there were duplicate informations which are being loaded in the AIS. So to remove these kind of challenges, they had the AI based processing of this information, and to ensure that these kind of so information which are coming from multiple sources are being verified, scrutinized and then removed and processed by them in the second phase of AIS. So going forward, as per the information or what is happening or what is in the news, is that probably in future Amazons and Flipkarts or the e-commerce operators might be asked to give the information of the customers who are paying cash on deliveries. So tax authorities are looking forward to collect such kind of information from the new tech commerce players to track people who are buying products through online by cash. Whether Amazon and Flipkart might not have the Aadhaar and PAN, but definitely they will be having their phone number, email ID and the GPS location where the product is delivered and the cash is collected. To this data can be asked. To that extent, they might go and track. That is how the developments are going upon. This is not there as of now, but there are talks in the industry to collect these kind of information to reduce the cash transaction in the open forum. So this is how the AIS look. I think all of you would be seeing, just I'm passing through the reference. There are possibilities of active and inactive information in the AIS. So you have this something coming here in terms of the credits through different vendors or the suppliers which are coming through based on the TDS information. Now if there is any revision, then the record will become inactive and only the active records get accumulated or aggregated to the final computation. Now there are 9 records, so we see that there are 9 records and 2,20,040 as the amount which is being as consolidated amount for all the transactions. But all the transactions you have active and inactive records. Only the active records is consolidated and considered. So there is a track and these are all eliminated in the AIS, and we'll have to take care of this information in order to see, not to consider all the data of both active and inactive, but only to consider the active records and verify that. So what all details will be available in AIS and TIS? Most of us know this, just I am running through the savings bank interest details or interest from different term deposits, recurring deposits, and we have any rental income received. So those transactions will come through, it will get reflected in the owner, where the tenant is claiming the HRA benefit from his employer. Now this information goes and sits to the owner's AIS system to see whether they are offering the rental income in their respective returns or not. Then cash deposits in bank account. So this is being from last 6 to 7 years, from 2016 onwards. There's a lot of focus on cash transactions and various cash deposits. So that is being monitored and tracked and reported, and processed information is now being available in the AIS from all aspects. Similarly, the cash withdrawals, we also know that section 194 is being introduced, where we have this cash transactions withdrawals are being monitored. Foreign travel expenditures information is also available on AIS for us to see and check whether this is one of the critical information for us to see if they are eligible or they are bound to file the ITR, because when I proceed further, the 7th provision of section 139 now mandates that people who have spent more than 2 lakhs of expenditure for foreign travel are now required to file the ITR even if their income is less than basic exemption limit. So these all things in the AIS will enable us to analyze whether they are bound to file the return or not. Gone are those days we will see only if I have income only I will file the return. Now from last couple of years there are mandatory provisions which are being coming through, where we'll have to check if they are coming under any of the provisions, where the return would be required to be filed mandatorily even though the taxpayer is not having any income, or the assessee or the individual is not having any income. So these are the information like purchase of foreign exchange currency. This is also one of the information, because again, if somebody's gone on a foreign travel, purchased foreign currency, all these things gets recorded there. Sale or purchase of land or building, again, capital receipts or the capital gain transactions needs to be evaluated. Any credit or debit card issued during the year. Now if you have spent or not spent, but if the credit card is issued to a person, now that information is being transformed into the AIS, and one can track what all credit cards I have taken during the year or what debit cards are issued in my name. This information will populate into the AIS, and these are the details that are available. Now let us see what is a TIS before we proceed to the other aspects. So this is how a snapshot of a TIS looks. So we get the information of all the kinds of heads of reportings that comes, like salary, dividend, interest from bank, interest from savings bank. Okay, so this interest from deposit, sale of securities, purchase of vehicle, because all these are coming through TDS, TCS transactions, and purchase of securities and units of mutual fund. So this is just a summary of some of the information, not that only it is restricted to this list. There are many other which can be coming through the TIS. Now if we see on the right hand side, there is something called as processed value and derived value. Now let us take a scenario. Now the information for the AIS is the annual information statement from various filers. So that is called the value which is received by the income tax authority, and that is automatically processed through the AI technology. Duplicates are removed and that becomes the reported value. And this will be available in the taxpayers login under the eCampaign tab, and this has to be verified by the taxpayers or the assessees, and if there is any discrepancy, they can report the discrepancy. If there is no discrepancy, they can accept it. Once it is accepted, it will become a processed value and it will become a derived value at the end. If there is any change, then that change will be processed and then it will become the derived value. In this example that the screenshot we see, processed value and derived value, there is no difference. That means this particular assessee, there is no anomalies or there is no critical differences which are being identified. So this is what we were discussing. Reported value is the source information. So processed value is value after processing, including duplications or any kind of AI based technological processing, and derived value is after based on the taxpayer's feedback. So that is, taxpayer can give feedback if it is not pertaining to the taxpayer, or if it is pertaining, if it is a duplicate information, or if it is a wrong information. All of that can be submitted, which we will be seeing shortly. So this is how it will reflect here. If you see here row number 3 and 4, the reported value is twice. The dividend information from a certain company is being reported twice, and then the processed, that is when the AI based processing is happening, one of the transaction is being eliminated and considered as zero, and only one source of information is considered to be processed, and only one set of income. Otherwise it would have become a duplicate income. So this is how we can see what is processed and what is the derived value. So let us say the reported value is 50 and the processed value is also 50, and according to assessee's information, if it is not correct, if it was only 25, then assessee can give a feedback in the eCampaign tab, and then the derived value will become 25. Derived value will become 25. So this is the options that are available. Most of us do not frequently use this option, or we have not explored, but that is the reason I am just taking through this. This was one of the pointers which was asked me to deal with, and accordingly we are discussing in today's session. Then moving on, like I said, there are, even after this AI based processing, certain time there is duplicate information which is being repeatedly coming in, but very less number of instances. But however, we do have certain instances in this fashion which needs to be addressed by way of giving a feedback and ask them to remove the duplicate value. So what happens if there is a difference in AIS and 26AS? So we'll have to submit the feedback on the portal, that is the eCampaign tab of the reporting insight portal. Now this, what all options we get under to submit the feedback. Now information is correct, that is the first possibility that I can accept the information. And there is a secondary option that I have, information is not taxable. If that information is not a taxable income, then I can submit it as information is not taxable. If it is not at all fully correct, I can write it as information not fully correct. I also have option if it is pertaining to earlier years or if it is pertaining to other person's PAN. Okay, if wrongly it has been coming to my portal or my login, I'll have to report that it is not pertaining to me. The moment I say it is not pertaining to me, it will ask for, then tell me to whom it pertains to. Then I might have to give details as to whom it pertains to. So I'll have to give such details. We'll see those screenshots I have given, that extracts also. How does the screens look? Information is duplicate included in other information, or if it is duplicate, like how we saw in the previous screen, the property transaction, sale transaction being reported twice. So if it is duplicate, I'll have to give a feedback stating that it is a duplicate information. Thereby, that one of such information will be removed from the AIS and only the actual transaction will be considered. Information is denied, and that is the last option that I will have, telling that this information is not at all mine. I am denying this, it is not pertaining to me. So let us see the options that we have. There is two sets of feedbacks that I can give. One is primary feedback or primary response, where this primary response option is available only to state when returns are not filed, why you have not filed the returns. Emailers come and we'll have to give a primary response stating that I don't have taxable income, or I am in the process of filing the return, or I have already filed. Apart from that, I have a feedback section. There are certain categories of information which is optional, and certain categories of information are expected to be responded as a feedback. Now this, where tax authorities or the risk strategy team or the risk management team has certain challenges in verifying the data, they might ask us to confirm the information through the reporting insight portal, and I will have a column called expected feedback. So this feedback column will show me in red stating that it is expected to respond as a feedback. Now I have to confirm whether these transactions are correct, pertaining to me or not. So this is an expected mandatory feedback that I need to give. So the functionality enables taxpayers to provide feedback on the information which is marked as expected under eCampaign. Where no feedback has been provided, then I have to, wherever there is no feedback, it will be showing as expected, and I have to report that feedback. Taxpayer is required to provide feedback on the information which is marked as expected. But as per law, there is no mandatory rule for me to respond to it, because it is there is no law enabling it. It is only procedural thing as a facility being given. Now, if we see the objective, in the Finance Act 2020-21, the Finance Minister has told that we will ensure that all the data will pre-fill the ITR. So this is the objective, that they are working towards facilitating that information automatically comes to the ITR filling. So in that verge, all these developments and information processing is being happening. And like I said, the first possibility is information is correct. If information is marked as correct, the reported value in the AIS will be taken as correct, and it will be considered to TIS as processed value and derived value. Next, if the information is not fully correct, then I have to mark it as not fully correct. The modified attributes and values are saved in the AIS. That means the moment I say it is not fully correct, that means I will get the option to edit the fields. Let us say there is a transaction sale of mutual fund for 10 lakh, but it is only 7 lakh. Now, when I say it is not fully correct, it will give me the option to edit that amount of 10 lakh or the quantity. If I am having any challenges in verifying that, let us say this is the screenshot how it looks. When I select the feedback option as information is not fully correct, then I will be editing whether the date of the transaction, value of the transaction, or what is the price at which it is sold, what is the date of acquisition. All of this can be edited and given the correct information, so that this will be processed for the TIS in the modified report. So the derived value will be considered after the taxpayer's feedback. The feedback will be processed in accordance with the risk management system. The moment I submit the feedback, this goes to the risk management system, and they will review it, and they will, if required, they might go back to the source information provider, and they might recheck, verify, and then process it. In cases where modification is substantial, or information source may be contacted to confirm the modification or provide additional information. So they might also come back to us to check if it is substantial, as to recheck. They might call us, they might write an email or send us a letter to take additional information. So if information is duplicate or included in other information, if I select this as an option, then the processed information will be, one of the line item will be taken as 0, like we saw in the previous screens where we saw there were 2 information in the reported value, but in the processed value we had only one value, and the other value was considered as 0. So the derived value will be reduced to one of the transaction only. If there are two transactions, similar thing in duplicate, then two line items, one line item will be considered as 0 and the other line item will be processed for the subsequent processing. This again will be verified by the risk management system, and then it will be a substantial information. They come back to us and reconfirm the data. If it relates to other PAN or other assessment year, then I'll have to give to which year it pertains, or I'll have to give to whom it pertains. I'll have to provide the data as to say it is other person. The moment I select the other person, I'll have to give the name, PAN of the other person and to which year and what is the kind of relationship of that particular person. If it is relative or if it is others or if it is a partner or a partnership firm, any kind of thing that I have to select here. Usually this happens when a property is purchased for the partnership firm in the name of the partner. So partnership firm cannot purchase the property, but it will be purchased in the name of the partner, and the TDS credit could have come to the name of the partner. But substantially or ideally in substance, the transaction is the to be recorded or would be recorded in the partnership form. So there I can use this feature to submit the feedback to state that it is not mine, it is pertaining to the firm, and I can give the firm PAN number so that this information will get translated into the partnership firm's information. If information is denied, again I will go back to the 0 and it will not be considered, and it will be rechecked in the risk management system, and accordingly it will be transferred. Then the last two other things is transfer not in the nature of sale or income is not taxable. Those are the two other options that will be available. If certain income is not taxable, then I have to report that as income is not taxable, so that will be considered as a feedback to be considered. Why is this critical? Why is this important? Because keeping quiet and waiting for notices to come and then ask to reconcile, rather than being patient enough to wait till then, it is better to take action out proactively and ensure that all the information that is being appearing on the AIS is pertaining to me. If not, let us take action today so that we don't get any notices on the later date. So that is the importance of doing this process of submitting the feedback. Now there are frequently asked questions on the AIS, like what is the limit or the number of times that I can submit the feedback on the AIS portal, or what is the possibility to modify the feedback that I have already given in the AIS. So there is no limit on the number of times that I can modify. For any number of times I can modify the feedback. Now when I go for modification of feedback, it asks me the reasons as to why am I modifying it. And there are 4 options telling that, okay, reason earlier given is incorrect, so that is why I am giving a resubmission. Information provided no longer valid, that means earlier what I had provided not valid. Okay. Other reasons, then I will have to provide the reason for which I am modifying. Can a response submitted be modified? Yes, and how many times? There is no limit. It can be modified. As of now, there is no restriction. To that extent, the liberty is there with the assessee or the taxpayer to keep submitting the response. So with this, I think we have set the context in the right tone to see what are the ITR changes, and we know that the ITR notification came on 10th February 2023. So notification number 4/2023, and ITR 7 also being notified in notification number 5/2023 dated 14th February. And on further notification, that is notification number 37 of 2022 dated 21st April 2022, has been given certain conditions as to when a return will become mandatory. We will see all those things. If I quickly showcase the kind of comparative dates on which the ITR is being notified for previous assessment year, that is assessment year 22-23 and assessment year 23-24, just for information. So last year we saw that the notification of ITRs came only on 30th March 2022 at the end of the financial year. But the Excel utility or the schema or the validations were made available quickly from 30th March onwards. If we see, most of the notifications for 22-23 were available by 13th of April till ITR 6 in case of schema and validations. And in case of ITR 7 also, it was made available by 20th of May 2022. So from March, within 45 to 50 days, all the schema and validations were available last year. Okay. But in the current year, though the ITR notification was made available on 10th February, the forms of schema and validations are still in the process of being provided to us. So if you see in the graded manner, in the month of April we had only till ITR 5. In the month of June we got for ITR 5 and 7 Excel utilities. Now we are waiting for ITR 6 to be notified. As of today, we don't have the utility for filing the ITR 6. And ITR 7 also was recently, the 30th of June, they have enabled the Excel utility. Okay. So now quickly moving on to the ITR 23-24 changes that we need to take care with this background. So first thing is the applicability of ITR 1. So earlier they were allowing certain categories of people who are those, that is under section 139(1) 7th provision, had a condition to state that if somebody had deposited more than 1 crore in the account, they are required to file the ITR. So, isn't it? So this condition is available from last 2 years. Somehow they felt that they should not be filing ITR 1 and they have restricted that the non-applicability of ITR 1 for such categories of people who have deposited more than 1 crore in the bank account. So for assessment year 22-23, assessee of the above category was allowed to file all the ITRs 1, 2, 3 or 4. For assessment year 23-24, now such assessee cannot be opting ITR 1, he should mandatorily go to ITR 2, 3 or 4 as the case may be. So this is the first important change. Then we'll go to the next option. So self-occupied property selection thing. We had this house property schedule, which had the categories of the type of property, which is self-occupied, let out, or the deemed to be let out property. Now this option was always available in all the ITRs, even for ITR 6. Now the ITR 6 is being commonly used by the companies. So section 22 says that the owner should occupy the property. Now it is a company is an artificial person as per section 22. Now company cannot occupy the property and select it as self-occupied property. So it was illogical to have this option for self-occupied property. So now they have removed that option of under the type of property under ITR 6. Now we have only 2 options, that is let out and deemed to be let out. So that is the next change. Earlier people used to say that if the registered office of the company is being there, they said that since office is there, or the registered office or the company's office is being in that location, they were selecting it as self-occupied property. So if office is being occupied there, then it is for self-occupied kind of purpose. People used to select that, but it was not logical. Now they have removed it out. Then comes the dividend tax. So we had section 115 BBD, concessional tax rate of 15% on dividend received by domestic company from an associated foreign company. Now this was there until we had the dividend exemption under section 1034 and the specific section 1015 BBE where we had the 10% tax over and above the 10 lakhs. Now after having removed all this exemption, now they felt that this DDT, this tax also should be paid at a regular rate instead of a concessional rate. So they have now brought parity after Finance Act 2022 to withdraw this benefit of a concessional rate for the domestic companies receiving dividend from a foreign company. Now under ITR 6, under Schedule OS, a reference of this line item stating that tax on dividend received by Indian company from specified foreign company, that is under section 115 BBD, has been done away with. Now I cannot report dividend there, I have to regularize and showcase all the dividends under one place so that it gets taxed at regular rate as the case may be applicable, 25, 30 or 22%, whatever the case may be. So this is one thing we'll have to check. All these things become very important because most of the times we will take reference from the previous year ITR. If previous year ITR it is filled under this particular column and this particular para, we will again fill it up there itself. Sometimes we oversee and sometimes we don't correlate that there is some change that we'll have to go to in different disclosure. In that aspect we'll have to be a little critical on these changes that are happening. So section 80 IB sunset clause was there until 31st March 2022. Whosoever was having this kind of facility, this deduction could have been claimed under those sections. But now any company which is operating after 31st March 2022 or establishing any unit as per section 80 IB, they will not be eligible to claim the deduction under 80 IB. So under schedule 80 IB have been amended to remove the rows allowing deduction under the obsolete provisions. So now the deduction under section 80 IB or the schedule 80 IB has been amended appropriately to take care of this sunset clause. So these are all these smaller changes. Let us see into the key changes that are there. in the ITR for 22-23 financial year, assessment year 23-24. The first important change is schedule VDA or newly introduced schedule, which is called as virtual digital assets, or this was the amendment which was brought in Finance Act 2020. So let us see now ITR 2, 3, 5 and 6 and 7 as this newly incorporated schedule VDA. So we'll have to give the details like what is the date of acquisition, date of transfer, under which head of income that I am offering this income, because I have an option to offer this income under capital gains or the PGBP. So I have a drop down being given there to select this particular transaction is being offered under capital gain or the PGBP. So like all of us know, there is a taxation section, tax charge, taxability section under section 115 BPH, which says that we will not get any expenditure apart from the cost of acquisition, and there is no benefit of the carry forward of losses if there is any loss, and there is no set off of losses of the transaction from one transaction to the another transaction also. So all the transaction has to be treated independently, and even if I have the unexhausted basic exemption limit, and if I have an income under VDA, I cannot use that unexhausted basic exemption limit. Let us say I have invested in one of the cryptocurrency or a virtual digital asset, and I have a profit of 2,70,000 rupees. Now I don't have any other income except for this 2,70,000 of income. Now this 2,70,000 will get straightly taxed as 30%, and it will not get the benefit of 2,50,000 of basic exemption limit. That is the taxability provisions as per section 115 BDH. So this taxable income will be recorded in the respective schedule, that is schedule CG or schedule PGBP or schedule BP, as per the classification that is provided. So how does the schedule look like? So this is the schedule which looks like, I'll have to give the first column is serial number and the second column is the date of acquisition. I'll have to give every transaction with date of acquisition. I cannot give a consolidated. Let us say I have done 100 transactions. I cannot tell all the 100 transactions was done on one date. If it is done on one date, then okay, otherwise I'll have to give all the different dates of transaction, date of transfer, like how each transaction of each script or each crypto or each virtual digital asset being transferred dates, I have to give that. In the column 4, now we have the classification to be given there, under which head of income I am offering this under CG or PGBP. Then comes the column 5, what is the cost of acquisition? From the date of acquisition, on the date of acquisition, what was the cost? Only that cost is allowed, no other cost is allowed, monitoring cost, AMC cost or rental cost, indirect expenses, nothing is allowed. Only the cost of acquisition is allowed. Consideration received is the sale consideration on the date of transfer, that will be considered as the sale price. Now the consideration received minus the cost of acquisition will become the profit or loss. Now if it is profit, that profit will be considered for taxation. If it is loss, that loss will become zero, that loss will not be offset against the other transaction. Okay. So let us see how does it look when I fill a transaction. So this is how, if we see the online filing portal. So date of acquisition, date of transfer, under which head, cost of acquisition, consideration received, and these 5 fields I have to fill, and the last field will automatically calculate. So 25 lakhs consideration received and cost of acquisition is 15 lakhs. So the income will automatically get calculated by itself. I need not type in. That is the last column, that is 10 lakhs. Now all the transactions that I have entered like this, if you see, I have taken here the reference of 2 transactions. The first transaction I have 10 lakhs of profit. The second transaction, the cost of acquisition is 5 lakh and the consideration received is 3 lakh. That means I have a 2 lakh of loss. So this 2 lakh will not come in the last column and get offset against the 10 lakhs. Okay. So each transaction is considered independent thereof, and it will be considered for taxation only if it is positive, and the negatives or the loss will be ignored. So the next thing is intraday trading. A separate disclosure has been asked for in the current year forms or the ITR disclosures. So in the new ITR form, we have a new line item being introduced under the schedule. So turnover from intraday trading is required to be given separately. Now we have, now let me ask how do we determine turnover for intraday trading? So what turnover has to be disclosed here as per all of you? So turnover for trading, intraday trading, all of you should be familiar or should be aware of this. So let me pause here to take certain feedback or certain insights from the audience here. So what do you feel? What turnover that I should be giving here?
Net sales.
Sales amount?
Net
So
whether it is profit or loss, it should be considered for a turnover.
So I have three types of answers. One is net, one is sales, one is the absolute values of profit or loss. Then I'll have to take that value as the turnover. Okay. So we do, as of now, let me say that there is no clarity as to what has to be filled, but they only asked that turnover from trading has to be given. But in my view, the kind of information that they are seeking here is not the information that we will consider for deriving the turnover for determining the applicability of tax audit under section 44AB. The guidance note guidance note for tax audit under section 44AB has given this methodology to consider the absolute values. But otherwise in the law we don't have that. We have only this is only to determine the turnover threshold limit for applicability of tax audit. Okay, so that is not that something that they are looking here to be reported. In my view, I have to take the gross sales figure and report here as the turnover from intraday trading. But we might see certain clarification or certain insights or the FAQ that they might release in respect of this. Now this was the schedule. Until last year ITR, we had only row number 12, but row number 13 and 14 or 12B is being introduced to state that I have to disclose the turnover from intraday trading. Now this is intraday trading. I have to give the trading value of the absolute sale figures, not the net figure or not the approach or the methodology prescribed under the 44AB guidance note. Income from intraday trading transferred to profit and loss account. So out of that intraday trading, how much of the profit is being transferred to
Friday, if you make 5 crores turnover, what will have some thousands of crores?
We'll have to report that, sir. But for the purpose of tax audit applicability, I can take that absolute. There might be mismatch, but that is explainable. I don't see there is any challenge because it is very clear to determine the turnover for applicability of tax audit. I might have 37 crores or 40 crores or 100 crores of turnover, absolute value. But when I see the actual loss or profit figures of each line item, and if I take the totals of the absolute numbers, then it can be less than 10 crores, because of which I have not done the tax audit. It should be fine, no problem, because that methodology is always it can be explained and provided as a clarification, or it can be always substantiated and established before the tax authorities.
And for the purpose of the declaration of being profit, what should be the turnover? Whether it has to be 6% or 8% to be taken on this turnover or this time?
I have to take on the guidance note turnover. Guidance note turnover, that absolute values is only to determine the threshold limit of applicability of tax audit.
Correct. So for declaring the 8% of the turnover, so which turnover should be taken? A 44AB turnover limit that we calculate, or this turnover which
That is only to determine the threshold limit, that's all. So 6% or 8%, correct. So then comes the changes in the donation schedule. Now we all knew that there are different mechanisms being prescribed for collecting the information of the donors from the charitable institutions or the trusts or the donees. So they have already have the information with respect to who have donated what and what is the amount and what date. Now the donor, if he is required to claim the donation deduction, then we need to mandatorily quote the ERN number.
This one intraday trading turnover, if I report sales,
Yes.
then if my turnover is 5 crores, then I have to report 6% as a profits, due profits.
Correct. Yes.
6%.
Otherwise, always we have the option of getting the books of accounts audited, tax audit, and that can be done. That is not an issue. If I am not getting it audited, then that is the fallback residual implication that could happen.
So 6%.
So it is not mandatory for me to always show 6%, right?
No, it's not mandatory, but if I report 5 crore, I have to report 6% on that one.
I would say it is not, if I report amount, that will automatically calculate 6%. I would say that if I report 5 crore, that could be the implication if I don't show the actual books of accounts, P&L, audit and all of that could be the implication.
If I take the support of 44AB guidance note and the way I calculate turnover there, if I take the same turnover here,
Correct.
then I'll have to report 6% of that amount.
Correct, sir. That's what that is only for determining the threshold limit for applicability of section 44AB turnover. That is not to calculate the deemed profit, or that is not to calculate the presumptive tax.
So at one point of time, I'm saying turnover is this amount.
Agree. That anomaly and that challenge is there.
Ah.
It can be contrarily, the department could claim the what you are telling. It has to be established, and we might have to wait for some more clarity and visibility as to what they will treat it as and what they would ask us to look at it.
Any case law available on this one?
As of now, this is a new disclosure that they have been asking.
No, not this one I'm telling you. For turnover.
I can check and get back, sir. I can look into it. Correct.
Because there must be some case law where
Yes, it will be there. We can check and get back.
No, because in zero line anything, they give the turnover as per the 44 AB. Whatever they give as a turnover, they give as per the 44 AB turnover.
Correct, but all the, I have seen the different statements, but not all of them are following that. Some of them follow the absolute value, some of them follow, apply the same rule for all the kinds of transactions. But intraday is different, short term is different, long term is different, and speculative is different, and options, futures are different. So I agree, some of them are following that, some of them are not following that. So, but we'll have to apply the provisions independently to check the applicability accordingly. We cannot blindly take that, but that can be only assisting us to cross-check. So moving on to the next thing, the donations thing. So the donor has to specifically mention the AR number which is received from the donee, that is the charitable institution or the trust, where he is eligible to claim the 50% of the deduction on the subject to eligible qualifying limit. So this is the schedule which is being introduced, where there is a column being added telling ARN or the donation reference number. Now this information will now be mapped at the back end by the system to check if the donee has already filed this information, and this ARN number is mapping at the back end along with the details of the name of the trustee or name of the trust, address of the trust or the amount and all of that, and accordingly the donation deduction will be granted. Otherwise, going forward, once the returns are processed, we might see discrepancy and disallowance or non-allowability of deductions to that extent, even if I have wrongly keyed in the ARN number. So if it does not match, even if a letter, instead of yes, if I have keyed in as 5, then gone, it will not match, and it might become a disallowance of deduction, or discrepancy can come in there. So this is how the table looks on the online portal. We'll have to give all this information, and on the portal, this is ARN donation reference number is being enabled, and we'll have to fill in separately for each of the donation, and I cannot do it for the one of the line item and the other of the line item. I don't have an option. So each donation I have to give the information appropriately. Moving on to the next thing, section 115 BAC. So section 115 BAC is the new regime taxation that is being introduced, and all of us know that people have already started utilizing the benefit under the new regime of taxation for the couple of years. So all these years we were asked to file form 10IE, then I opt for section 115 BAC to ensure that I have been utilizing the benefit. And this was mandated only in case of business assessees, not for other assessees who do not have business income. So when I say this, so they want the option or the intention of collecting this form 10IE is to track that, because the entire regime or the facility to business person is to opt in once, and if he has to opt out, he can only opt out once, again he cannot come into the scheme. So opt in once, opt out once, and again he cannot come into the regime. So now they have asked for additional information to see and check whether you have opted in earlier, when you had opted in, what was the acknowledgement number, what was the date of filing form 10E, and all of that information I have to give when I had opted for it. And it will also ask if I have come out of the new regime and come back to the old regime? If so, in which year I had come out of it? And again, when I have come out, I have to file the form 10IE. So it asks for the 10IE filing date, acknowledgement number. So opt-in 10IE, opt-out 10IE, both will be asked for from the current year return. Earlier, it was only one simple disclosure. It said that, are you opting for 115 BAC? Yes or no? I used to give yes and then go ahead, no means no. If I give it as yes, then it will used to ask what is the date of form 10IE filing and the acknowledgement number. Now, it will also ask me the additional question to check, have you ever opted out from section 115 BAC in the earlier years? So this is the newly added or the new section or the new question being asked. I have to select yes if I have opted out, and then option for current assessment year, what I have been taking, whether I am opting now or not. So opting in, not opting, continuing to opt out. So even if I am selecting that I had already opted in, I have never opted out. Now what I am doing? I am continuing to opt in, or I am opting out now. So I have to select the appropriate column and disclose it under section 115 BAC. This is how the PDF paper return disclosure look like. So 115 BAC, we'll have to question A, question B, all of this is being asked.
That's only for the business entities.
Correct.
For the salary.
And this will be valid only till for this current assessment year. From next assessment year, the new regime will become the default regime, and if I have to opt for old regime, then I will have to file form 10IEA, which is newly introduced form. So 10IE is for new regime opting till assessment year 23-24. From assessment year 24-25 onwards, the new regime will become the default system, and if I have to opt for old regime, 10IE need not be filed, but I have to file another form which is already notified, form 10IEA. And A next to 10IE. Okay, existing form is 10IE, and A next to that is the new form which is given for opting to the old regime from next year onwards.
Everyone or only for business assessors?
That is again for only for business assessors. Other changes like we have in the advances schedule in the ITR 3. So any advances being done, it seeks for the two details. What are those two details? Out of the advances given, how much of it is given to the related parties, 48 parties and other parties. So I have to give that disclosure bifurcation now. Earlier advance from others, I only tell advances from others. Now I have to give out of that from persons specified in section 40A2B of the Income Tax Act and from others. So I have to give this disclosure of how much of it pertains from the related party and how much of it pertains from the others. So this is bifurcation is critical and need to be noted while filing ITR returns in the current year. I'm also giving the online portal how it looks. So out of 9,10,000, how much of it 8 lakh is from others and from the related party 1 lakh, and this is how the schedule looks like. So both of that will get consolidated as the total advances from others. Then comes the changes in the partnership form, that is ITR 5. Any addition or any resignation we need to report. In the kind of where there is a retirement of a partner from a partnership firm. Earlier we used to give name of a partner, okay, name of a partner or a member, date of admission or retirement, and then we used to give the percentage of shares that he had held as a retiring partner, and when he had admitted or retired, the date of admission and whether it is admission or retirement. Along with these 4 details which were existing, now we are supposed to give 2 more additional details, that is the PAN number of such retiring partner and what is the remuneration paid or payable in case of the retiring partner. Okay, so what is the remuneration amount due at the time of retirement. So this information has become mandatory, and this is how the 2 new additional columns look in the ITR 5 in case where the partner is retiring from the partnership firm. Now this has to be computed and being given, and once this is given, probably this can be cross-checked under the retiring partner's return whether he is offering that as remuneration or not. So you can check that. And usually this is also being asked for to check certain times the remuneration or the amount paid is paid in the form of other than the actual money by way of distribution of immobile properties also. And then small disclosure change in the FIIs and FPIs. So in case of ITR 2, 3 and 5, if somebody is having who is a FII and FPI, and they need to give the SEBI registration number. Earlier this was not asked. Now there is a specific column. The moment I say, are you, the question answering telling that whether you are an FII or FPI, the moment I say yes, then I'll have to provide the SEBI registration number. So this is how it looks like. The SEBI registration number pop-up will come in, then I'll have to fill in the SEBI registration number to update in the ITR data. Then we'll move to the ITR 7 changes. So there are critical changes being made in the ITR 7 from the disclosure perspective. So there's a new schedule which is being introduced, Schedule IA and DA, and there's Schedule J which needs to be reconciled, and there is a breakup of investments under 11.5 modes, and there is Schedule R, reconciliation between the two different funds, corpus fund and the investments under 11.5, and Schedule A, that is the earlier two schedules were there, that is revenue expenditure and capital expenditure, spendings in revenue and spendings in capital. There were two different schedules, Schedule EC and Schedule ER. Now that is being consolidated as Schedule A, calling it as application of funds. Schedule A means application of funds. So let us quickly see each of the schedules. So Schedule IA and DA talks about the accumulated income taxed in the earlier years. So I'll have to give the details of the accumulated income taxed in earlier years and to which year it is pertaining from the accumulation of income, and assessment year in which the amount referred to in column 6 Schedule I was taxed. So it has an information coming in from Schedule I as well, and it also looks for where this income is getting accumulated. Now they want this breakup of this information. So this becomes critical and little challenging. Now if we have to start working towards it to break up into different years and see the breakup and the appropriate amount for different years, we might have to now open up all the books of accounts for the previous years and consolidate the relevant information. If it is in a one consolidated ledger or one GL, then it becomes difficult to see what it pertains to. If different funds and different accounts are being maintained for different categories of the income, then it is good to easily accessible. Otherwise it would become difficult. I would say that we should start looking and reviewing, filling the information from now to see what has to be verified and collated in advance. Then comes the Schedule DA. So details of accumulated income taxed in earlier assessment year as per section 11(1)(b). That means if I have already accumulated, and if I have accumulated, I will file Form 10B or Form 9, Form 10 and Form 9 to say that I will spend it in a subsequent year if I am not able to spend it in a current year. So I might state that for which particular purpose I will spend it, say next 1 year or 2 year or 3 year or 5 years. So within that period, if I have not spent it, or if I have spent it for a wrong purpose, and because of that it is being taxed, that information is being calculated here or disclosed here as to say in which year such kind of income being taxed under section 11(1)(b). So these are all information that they are collating to see the reconciling the earlier year records. For this will become the database for their earlier year's assessment progressing. Then comes the Schedule J. So whatever funds that I have to map it to the investments that I have made under specified mode under section 11 subsection 5. So that I have to give it in Schedule J as to say how much of it is in fixed deposit, how much of it is in bank, how much of it is in mutual fund, how much of it is in building, how much of it is in different categories of assets. So earlier the details of investment made under section 11(5) were to be provided in Schedule J. Now the form seeks only the details of corpus investment or deposits made under section 11(5). Now earlier I had to give everything, now I will be giving only about the breakup for the corpus and the respective deposits. Then the breakup of investments. So quickly if we see, the investments that I had shown in Schedule J has to be split up out of the investments made, how much of it is in 11(5) and how much of it is not in 11(5). So this is the breakup of investments that is coming in Schedule J. So So the breakup of total application of funds shown in the balance sheet shall be further classified into how much of the investments made in the modes specified under section 11.5 and how much of the investments are not in line with the section 11.5. So this breakup will become difficult unless I have proper records and registers in terms of the assets and the investments. Then comes the reconciliation of corpus, that is schedule R. A new schedule has been inserted wherein the reconciliation of the corpus of this schedule J and the balance sheet is to be shown. Whatever I have disclosed in schedule J, the investments in 11.5 modes that I have given, right? Add that along with my balance sheet. What investments I am showing in balance sheet and what investments I have disclosed in schedule J, I have to give the reconciliation as to say what is the difference and reasons for difference. So the reasons for difference in the closing balance of the corpus shown in the schedule J and the closing balance as per the balance sheet are to be given. How I can give? There can be, the reasons can be or the difference can be due to purchase of fixed assets. If I purchase the fixed assets, that will not be in my 11.5. So I can give it as purchase of fixed assets. And if there is a depreciation, I might have received 1 crore money for purchasing the building and I might have purchased 1 crore building. And if I have, after 5 years, the depreciated value can be 40 lakhs. So I have 1 crore on the corpus side and I have 40 lakhs on the asset side. Now what is the difference of that 60 lakhs? 60 lakhs is depreciation. Now I'll have to link that difference to be stating that as 60 lakhs is depreciation, and they've given any other reason as to why there could be difference. I can specify that reason there. So schedule R, this is how the balance of the schedule looks like. Closing balance of schedule J as on 31st March 2023, and what are the reasons for difference? That is either I have purchased fixed assets or due to depreciation or for any other reason, and that should be tying up with my closing balance as on 31st March 2023 as per balance sheet. So this is almost similar to our BRS kind of situation where we have to reconcile the assets on the balance sheet with the investments in the or the corpus amount in the schedule J. Then comes the schedule A. Earlier we had ER for revenue application of funds and EC for capital application of funds. Now this has been now merged into schedule A. Now if you see the schedule, you will be able to understand very clearly. Earlier only one amount column used to be there. Now they have kept into 2 columns. How much of it is revenue, how much of it is capital and total. So they are covering both EC and ER in one schedule under schedule A. So this schedule A now has to be verified or in terms of classification of how much of it is revenue and how much of it is capital side by side, and it is made easier. So these are the different changes or the different amendments in terms of the forms that what needs to be taken care as the new disclosures or modified disclosures or the mandatory disclosures that we are required to take care for assessment year 23-24. Now let us see some common points as something that we could miss out erroneously or frequently seen areas of less focus or where we could inadvertently make some wrong disclosure, where we should be more careful. Because why we should be more careful? Because ITR is the master document, or this is the kind of source document not only for income tax authorities but also for various other legal authorities or the regulatory authorities, including up to enforcement directorate and the GST authorities or the indirect tax or the different various authorities. So the information that we give in ITR would become the first source of information for all proceedings or for all verification purposes. So considering that, we'll have to see what are the important details that we should take care in order to disclose appropriately. One is the director details. So there is a segment where we need to disclose whether you were director in a company at any time during the previous year. So if yes, I have to give the name of a company, type of company. Under type of company, it lasts domestic company or foreign company. I have to select appropriately, and PAN number the company should be given. Whether its shares are listed or unlisted, I have to give, and then I have to give the director identification number. So furnishing of PAN and DIN is not mandatory in case of a foreign company, because foreign companies will not have the PAN or DIN, so it is not mandatory for foreign company. The moment I select foreign company, these two information will become optional. If foreign company has obtained a PAN in India, then it becomes mandatory for me to give the PAN number. But director in a foreign company, DIN is not mandatory, so DIN might not be necessary to give. So this is the kind of information that we'll ask for. Now we might have to understand and see if he is a non-resident person, what kind of information should be given. If he is a resident person, what kind of information should be given. Let us see that. If a non-resident person is only a director in a foreign company, if he is only a director in a foreign company, then which does not have any income, so that foreign company does not have any income in India, then he can give a negative confirmation saying that he is not a director in any company. So he need not give those information because foreign company is altogether having no presence in India and that is not required to be given. But a non-resident taxpayer who is a director in a domestic company or an Indian company, then even though he is a non-resident taxpayer, he need to give such disclosure to state that he is a director in a domestic company along with the requisite details. But a resident taxpayer has to give all the details including foreign company and domestic company without any optional situation for him to select on the basis what he need to disclose. It will become mandatory for him to give both domestic company directorship details and the foreign company directorship details. Next thing is nature of business. Most of the times we give lesser importance to ascertain the nature of business under which the taxpayer or the assessee is being carrying out as business or trade. So this has to be monitored or reviewed year on year basis. Sometimes the business of the assessee are dynamically getting changed from year on year or for a certain period of time. Most of the time this will be filled in the first year of operation and then it will go unnoticed as to say if this needs amendment or revision. So this has to be reviewed. And this also need to be mapped with the information that will be filled in the tax audit report, because tax audit report also will ask for the nature of business in the code. So that and this has to be same. So there are instances where the code disclosed in the tax audit report and the ITR are not matching, and they have been asking the clarification as to what is the exact nature of business. So it will become important for us to take a step closer attention to it and verify and review it appropriately before proceeding further. So we all know that CBDT and CBIC had signed kind of contract kind of thing or an arrangement between them for exchange of data from the GST database to income tax and income tax database to GST. Okay, so there could be lot of differences between the turnover. If I see AIs, now turnover reported under GST is also coming under Form 26A of the AIs. So this definitely there will be differences between the GST turnover and the income tax turnover for various reasons. Okay, it could be exempt turnover, taxable turnover, it could be RCM turnover, composition turnover, various reasons. So all of that, it is suggested that we have the reconciliation done between the turnover appearing in the 26As and as per the GST records, and keep that reconciliation statement ready now itself, so that whenever there is a notification notice or a letter or a clarification being sought by either of the authority, either the GST authority or the income tax authority, it would be ideal and it would be readily available for us to submit the justification. And this is a case where notices are being coming in for 17, 18, 18, 19, where there are differences between the GST turnover and the income tax turnover. So most of the times the income from house property or the taxable income or the rent is charged for GST at 100% or GST is charged. So I would have disclosed my rental income for GST for entire 1 crore rupees, 18% on it. But when I am offering that it is a rental income for me, I would have claimed the 30% standard deduction and the interest on loan and all of that. To that extent, my income is lesser when compared to the turnover declared under the GST records. Usually there will be differences in these kind of situations and there could be various other reasons also. Now it is better for me to record these reasons, reconcile and keep the information readily available for me to provide whenever it is called for. So coming back to the 7th proviso, where we have the conditions or the specific requisites where filing of income tax return becomes mandatory. Okay, so we all know that section 139 had told that people who are coming under 7th provision need to file the return, where 3 conditions we all knew earlier, that deposits being more than 1 crore and electricity expenditure more than 1 lakh and foreign travel expenditure more than 2 lakh are people who are incurred or falling under these 3 conditions. Are any of this one condition is mandatorily required to file the ITR, even though if you do not have any other income. Along with that, there is 4th condition, fulfills such other condition as may be prescribed. So this prescription came in 2022 and they said these are the incomes that they referred to, telling that professional receipts more than 10 lakh during the year, they are mandatorily required to file the return of income. Business sales, that is the proceeds from any business or a transaction which is more than 60 lakhs, they have to file the return of income mandatorily. They cannot tell I have lost so I will leave it, I will not file. And they also mentioned that if somebody is in credit of TDS and TCS to the tune of 25,000 rupees, and in case of senior citizen up to 50,000 rupees, then those category of people who have the TDS and TCS credit are mandatorily required to file the ITR. Somebody can tell, anyhow TDS amount is there, right? TDS amount, anyhow I should claim only refund, let me not claim it, let me not file the return. So that was the kind of behavior and the inputs or the assessee can think of, telling that anyhow TDS only, right? Anyhow I need not pay any tax only, it is TDS refund, so I am not taking claim refund, so I have not filed the return of income. So that cannot become a reason, because the TDS could be at 1%, 2%, 5%, but the income that I should pay to government or the tax that I need to pay on such income could be at 20% or 30%. So appropriately I need to disclose it. But however, even though if it is less than the basic exemption limit, I would be required to file the return of income. So foreign travel, electricity bill, all these were earlier available. One more new thing is credits to bank, which was under this prescribed rule, telling that where deposits in aggregate in savings bank account is 50 lakhs or more. So this is a critical one. Earlier one we saw that 1 crore thing mainly coming there already. Now this they are monitoring under the savings bank account. Now we'll have to see, this is a critical thing to play around by the tax authorities. Once this information is available, they can send notices for those people who have not filed their returns if they are triggering this condition. Now, what is this condition tell? If the plain reading says that where the deposit in aggregate in savings bank accounts is rupees 50 lakhs or more during the year. Savings bank account, they only say savings bank account. That means not for business associates other than business associates who have savings bank account. Now, if I am having a savings bank account, whether this limit of 50 lakhs, so I might have 2 or 3 savings bank account. So whether this limit of 50 lakhs applicable to each of the banks or each of the accounts from the same bank or different banks. So, but they have used the word telling aggregate. So aggregate means all banks put together if I have credits. Now what is the credit? The credit only they have told. They have not defined whether it is income credit, whether it is contra credit, whether it is loan credit, whether it is insurance proceeds credit, or whether it is insurance claim proceeds credit.
Savings to savings transfer.
That is savings to say contra credit. So that also can be considered as a credit, or any transactions. Probably my father needed some money, I have transferred, now he has returned back. Now the money that comes back from my father is also a credit for me, and the money that has gone from me to my father is also a credit for him in his savings bank account. So that is very critical, which will become, so this is the kind of credits to bank. All these can be considered as credits. More than 50 lakhs credits in the bank, even if it is only agriculture income, that also can be credits, because they are not defined or they are not excluded or restricted something to define what is credit. So they are only clearly told aggregate of all the credits in the savings bank account during the year. If it is more than 50 lakhs, then it will be considered as they have to file the return of income. So even if it is only agriculture income, if I have credits of more than 50 lakhs, even if I don't have income, I have to file the return of income to disclose that I have agriculture income and it is not taxable. Sold a property or sold a car which is for loss, even if it is for loss, I will have to file the return of income. Fixed deposit matures. I have done a fixed deposit. I have created a beautiful option given by the relationship manager of my bank account. Why are you keeping money in your savings bank account? We will create a sweeping automatic that credit or transfer to FD, and whenever you need, that comes back from FD to savings bank account. Instead of getting 3%, you can earn 6%. Yes, it sounds very good, and I say that okay, I approve it, telling that okay, you enable this feature for me. Whenever there is excess fund, you transfer it to FD, and whenever I need it, automatically recredits back to my savings bank account. So even those credits could be considered as credits into the bank account. Now I could take a bank term loan, or I could take a housing loan, I can take a personal loan, I can take house construction loan. All of this loan amount also can be considered as credit in the bank account, and that also can be considered for me to review and file the return of income, though I don't have any taxable income. Now I made an insurance claim, that also will be considered as a credit because it is coming and hitting my bank account. So if it once it gets in my bank account as a credit, that should be considered. So like we discussed, whether it is one bank or all the banks, so it is all the banks in total. What about contra entries? Same person transferring from one account to another account, that also will be considered as credit. So there is no option called net of credits and debit. Like I said, I have given 1 lakh every month to my father, and he has given me back 6 lakhs. So out of 12 lakhs, 6 lakhs he has given back. So whether it should, for him, it should be considered only 6 lakhs? No, for him it will be considered as 12 lakhs because 12 lakhs has got credited in his bank account. So he cannot take the net off of the payments returned to me, and he cannot say on a net basis I have received only 6 lakhs. So it should be considered the exclusively only the credits.
Which year is it?
This year, because it was notified in April 2022, this notification.
This foreign travel,
This is the rule 12AB, rule number 12AB. The last one, the deposit in one or more savings bank account of person in aggregate is rupees 50 lakhs or more during the year. So rule 12AB, it was not notified or specified. This is coming from 7th proviso of section 139. In 7th proviso of section 139, the 4th clause or the 4th point says that fulfill such other condition as may be prescribed. This was not prescribed until now, but in April 2022 it was prescribed by way of rule 12AB. Under that, 4th clause is the credits into savings bank account in aggregate more than 50 lakhs during the year.
this one foreign travel, 2 lakhs, debit. If the foreign travel is paid by the children.
Correct. So that is what I have this example also here, so which I am coming to. So a son is an NRI booking business class travel tickets for his parents. So expenses booked is, that is 2.5 lakhs as the travel expenditure for booking the to and fare or both side travel, 2.5 lakhs. So whether NRI should file the returns. Who is traveling? Parents are traveling. Whose expenditure is actually it is incurred for and on behalf of the parents. Parents are residents in India, but son is sitting in a foreign country who is an NRI. Now, since he has incurred or spent that money of 2.5 lakhs in India for foreign travel, should he file the return of income? As per clear reading, it says that, or the clarifications provided, the person who is incurring the expenditure is required to file the return, whether it is he is incurred for himself or for any other person. The person who has incurred the expenditure for him, he is required to file the return of income. Probably a group of friends, probably 5 people are going on a foreign travel, only one person is buying this thing, and all the 4 has not incurred. Ideally that will not get reflected, but it will get reflected in that one person who has purchased the foreign travel tickets. Now it will be, he is required to file the return and not the other 4. So ideally it is the person who has incurred the foreign travel expenditure, whether it is for himself or anybody else. So NRI now has to file the return of income in India because he has incurred that expenditure of more than 2 lakhs for foreign travel expenditure. So this new 7th proviso, the credits in bank account, all of this. So what is better? We have doubts what credits has to be considered, whether net, whether only income credits, whether only loan credits, or what credits, what has to be done when in doubt. So we are in doubt, or all of us are in doubt, right? What credits has to be considered, whether a return needs to be filed or not. So what happens if I am required to file the return, but I have not filed the return? What happens? Non-filing consequences, I might be charged into these 3 different sections, that is, or proceedings. One is the late fee under section 234F, 5,000 or 1,050, as the case may be. If found guilty, penalty can be levied, and prosecution can go up to 3 months to 24 months. So this is the consequence. So when in doubt, it is better to file to avoid these consequences. So it is better to file the written-off income. So though it is not having any income, but it is better to disclose that these are my small interest income or small rental income which is less than 5 lakh, whatever it might be. Disclose the available information, disclose the income which are there, which might be less than the taxable limits, and file the written-off income, which could be a nil return also. So the next schedule is Schedule A, which needs to be looked into in a critical aspect. There are a lot of pointers needs to be considered in terms of how it needs to be filled or how it needs to be disclosed. So this is applicable in case where income is more than 50 lakhs for a particular taxpayer. What all needs to be given? So details of immobile assets, mobile assets, all of this needs to be given. Jewelry value, vehicles value, financial assets, that is investments in insurance, banks, shares, securities, mutual fund, insurance policy, loans, all of that, and also the corresponding liability on all the above assets also needs to be disclosed. Now, if I am a business person and if I am filing ITR 3, and where I have my books of accounts, where all my assets are forming part of my regular books of accounts, where I have consolidated into a financial statements, that is statement of assets and liabilities and statement of profit and loss. So in this statement of assets and liability, all my assets are already there. Now I have already, this information will form part of my balance sheet in the ITR in ITR 3, isn't it? So at that point in time, am I required to fill this schedule AL? How many of you say yes? How many of you feel it needs to be filled in schedule AL also? Okay, what about others? Yes? Because schedule A is specifically given if my income is more than 50 lakhs, then I'll have to fill the schedule A because it is applicable. So what do you feel? It has to be filled? Okay. So this is the extract of the ITR 2. Okay. ITR 2, assets and liabilities at the end of the year, applicable in case where total income exceeds 50 lakhs. So ITR 2 does not have a provision of business income or balance sheet as a form of information in the ITR 2 as the form design itself. But when it comes to ITR 3, they have been given clarification to state that what is not forming part of your balance sheet, only those needs to be filled in schedule A. If everything is forming part of your balance sheet or regular books of accounts, then you need not fill schedule A. So this is one thing which it was observed that both the places information is being filled, but it is not necessary if it is already forming part of my balance sheet. Now there are cases where the proprietors or individuals prepare balance sheet only for business purpose, but they might have personal assets apart from what is forming part of the balance sheet. So those assets which are not forming my business balance sheet, then those assets will come under the schedule A. So I need not refill the or provide the information again which is already filled in the balance sheet of ITR 3 in the schedule A in case of business associates or where I am filling ITR 3. Or it can be also a case where I have not maintained regular books of accounts, where I will give only certain specified information, what is my debtors balance, creditors balance, what is my stock, inventory and all of that. At that point in time, I might have to fill schedule A because I have not filled all the information in terms of my immobile properties, mobile assets, bank balance, all of that needs to be filled here. Okay. Now there is this schedule in ITR 6 also, schedule AL1. So unlisted companies are required to fill schedule AL1. That means unlisted companies means any company which is not listed or a regular private limited company or a closely held company is required to fill this thing. This schedule is not required to be filled up by the foreign unlisted companies. So if it is a foreign unlisted company, it is not required to be filled. If a foreign company is having any operations in India like a project office or a branch office or any subsidiary company, and if they are filing the return of income in India, then they might not be required to fill this company, only the Indian unlisted companies. If the company is a startup company which is recognized under section 80 IAC by filling form 2 and recognized under DPIIT, then they are required to fill a separate schedule which is specifically designed for them, schedule AL2 and not schedule AL1. Even details of assets held as stock in trade of business are also required to be reported. Okay, so details of assets held as stock in trade is also required to be reported here. Only the aggregate values are required to be filled up, and the particular details of each asset held as stock in trade is not required to be reported. Purpose for which used as stock in trade has to be selected. So in my list of assets, I have to select a stock in trade or for the purpose for which it is used, but it has to be filled separately. In case of unlisted company holds foreign assets, if they have any foreign assets, then during the previous year, which have been duly reported in the Schedule FA, the same is also required to be reported here, because there is one more schedule which says foreign assets, Schedule FA. Now all the assets, whether I am a beneficial owner, whether I am an actual owner, or I am a legal owner, I will be required to fill Schedule FA. Even though information is already filled in Schedule FA, then I will have to fill I will be required to fill Schedule AL1 in case of unlisted companies.
Unlisted companies, private company. If it is a private company, any of they would have filled the balance sheet schedules and everything. Even then, we have to duplicate the same figures here.
Yes. Now this is a contrary when we consider ITR 3 and ITR 6. ITR 3 is for not for companies, but if it is other than companies. ITR 6 is for companies that given specifically that it needs to be filled based on the instructions from the ITR form. It states that even if it is already forming part of balance sheet, I will have to fill Schedule AL1. Now this Schedule AL1 can give more insights in terms of the categories of assets that I might have. I might disclose as fixed assets, WDV only, but here I will be disclosing all the breakup of movable properties, immovable properties, assets, shares, investments, loans, all of that. So they might have the deeper insights on the breakup of the value already forming part of my balance sheet. This schedule is only required to be filled by assets and liabilities at the end of the year. What is the value at the end of the year? I need not give the value if there is no value. Let us say I had immovable property till 29th March 2023 and I sold it on 30th March 2023. As on 31st March it is not there. I need not fill that. Okay? Assets and liabilities at the end of the year. The value as at the end of the year needs to be filled in this schedule. If he is a non-resident or a resident and ordinary resident, only the details of assets located in India needs to be filled in Schedule A. Okay? They are not required to fill the foreign assets information here because it is only for residents. Even if you see the Schedule FA applicability, Schedule FA applicability is only there for resident assessees and not for RMOR and NR. If you have held foreign assets during the previous year which have been duly reported in Schedule FA, even then you are required to report such foreign asset again in Schedule AL. This is only for resident assessees, not for non-resident and not ordinary resident. Now what is the value that I need to disclose here? Whether it is the balance sheet value or the market value, realizable value or the cost. So it is very clearly given in the instructions. The cost of the asset or the cost price of such asset to the assessee needs to be disclosed. Okay? If it has come through a gift, then cost to the previous owner needs to be disclosed here. If it is through a gift, then it is cost to the previous owner needs to be given here. If you are not able to ascertain the cost to the previous owner, then you will have to take the fair value and as on the date of the receipt, you will have to determine the value as cost and be disclosed here. So the first preference is the cost, or the cost only needs to be filled. Let us say I have taken a policy, life insurance policy which has a sum assured of 40 lakhs and I am paying premium of 3 lakhs every year. So I paid this yearly premium for 4 years. So 4 into 3, 12 lakhs is the cost that I have incurred for purchase of that policy. So my value is 12, investment in policies is 12 lakhs, not 10 lakhs, okay, or not 40 lakhs. So it is sum assured is, 40 lakhs is the sum assured. So I should not be reporting 40 lakhs, I should be reporting only the cost for such, acquiring such insurance policy, that is 12 lakhs. So cost is the criteria that I need to fill. Even if I have purchased an immovable property in say 2004, the cost was 1 crore rupees. Today that cost can be 17 crores or 20 crores or 25 crores. But I need to fill only 1 crore as my cost of immovable property. Okay. So can you all answer this question? If I have only house property rental income and husband and wife are the joint owners of that house property, and income is less than 50 lakhs, okay, and they have only one house property. They have no other provisions or rules are getting applied to them, or they are not getting into triggered of any of those 139 7th proviso or the prescribed rule 12AB conditions. They are not getting into triggering any of those conditions. Now, which ITR they have to file?
ITR 1.
ITR 1. All of you are comfortable with ITR 1?
Joint ownership, there was a confusion. I think we clarified it as ITR 1.
So let me tell, for joint ownership, ITR 1 is not applicable, even though if they have only rental income and only one income is less than 50 lakhs, I cannot go for ITR 1, I will have to go for ITR 2. Okay. So joint ownership detail, where in the house property schedule I will give 100% ownership or 50% ownership, and who is the respective corresponding owner. I will have to give the details of the corresponding owners and the share of ownership of the other owners. That information cannot be filled in ITR 1. So most of them do what they do is, let us say if it is they have received 10 lakhs of rental income, they say 5 lakhs is my 100% income and file ITR 1. So that should not be done. I will have to fill ITR 2, tell 10 lakhs is my rental income and fill 50% is the share of ownership, so that automatically 5 lakhs will get considered in my written off income. And below it lasts, if the ownership is not 100%, what are the details of the other owners along with their name, PAN and the share of ownership needs to be filled. Okay, so this will happen in the ITR 2 and it will not happen in ITR 1. Then comes the Schedule FA. Schedule FA is again the foreign assets. You have different various tables which says table A1 to table G, A1, A2, A3, A4, table B, C, D, E, F, G. So we'll have to give the information of foreign depository accounts, custodian accounts, any foreign cash, foreign interest, foreign bank accounts details, or foreign investment in any properties, shares, all of that. This will become very critical in case of where employees of multinational companies, where they would have got the ESOPs, or they would have got the RSUs, or they would have got the ESS or RSS of the share subscription scheme plans. So this will become very critical to be disclosed in one of the applicable tables. So there is a question in the general information or the part general where it says, do you at any time during the previous year hold as beneficial owner, beneficiary or otherwise any asset including financial interest in any entity, having any signing authority in any account located outside India, or have income from any source outside India? Now most of the time this goes unnoticed and automatically some no will be there, some software will ask something, sometimes no would have been already filled. Sometimes this basic information will get rolled over from previous year information to the current year information, and when it is validated or it is checked for any errors, it does not pop up because it is already filled as no. We might also not know that there is some kind of question that it is already answered as no, so it is better to generate the return and check, and we'll have to click yes if any of these conditions is getting triggered. The moment this is selected as yes, we'll have to fill the Schedule FA. Now, who should report this Schedule FA? If a person is a resident in India, then he is required to furnish details of all the foreign assets that he has. Mandatory for resident. Okay? Resident being any kind of owner, beneficial owner or a simple beneficiary or a legal owner. Okay? So there can be three kinds of ownership. I am the actual owner, that is the legal owner, or I am only the beneficiary. I am not the beneficial owner also, but any benefit that is derived from that is me as the beneficiary. Then also I am considered as the owner, or I am a beneficial owner, though I am not a statutory or a legal owner, but I am only the beneficial owner. Even in that situation, I will have to be disclosing that information in the Schedule FA. So any of these three categories I will have to report under Schedule FA. This schedule need not be filled up if one is a not ordinary resident or a non-resident. Like I said earlier, if this is applicable only for resident taxpayer and not to a RNOR and NR. So resident means resident and ordinary resident only. Details are required to be reported even if the specified asset is held even in a single day. Unlike Schedule AL, Schedule AL says the values of assets that are held as on 31st March 2023. But in Schedule FA, even if I have possessed the asset outside India as a beneficial owner or a legal owner or as a beneficiary, even for a single day, then I have to report such information in Schedule FA. Now, if somebody has held foreign assets during the previous year, which have been already been reported under Schedule FA, then even then the Schedule A has to be filled, which we have already discussed in Schedule A. Now, the values of the foreign currency conversions, it has to be considered based on the TT buying rate of the foreign currency as the exchange rate adopted by the State Bank of India. For us to report the values in INR, I cannot report I have got ESOP for $10 into 100 shares, so $1,000. I cannot report $1,000 in the ITR. So I have to report the $1,000 equivalent INR in the ITR. So how do I convert that equivalent INR of the foreign currency? By adopting the TT buying rate of the SBI notified exchange rates.
Form 1 is accepted for co-owners by income tax. What should be?
As per instructions or the rules given, it is not
accepted
accepted.
in income tax.
But do we have that information to fill the co-owners details?
Yes.
But the instruction.
Yesterday we have filed.
Okay, so the
54 co-owners.
54 co-owners.
Yes. But Form 2 is not going.
Okay.
Because every time when we file, it is in shares are not coming to 100. Error is showing.
But why the shares will not come to 100?
Manually we have total everything is correct. 2021 same problem, we complied, they rectified it. 2022 it was okay. 2023 again same problem.
Technical issues probably they might be working on.
Who is Infosys?
So, what is the reporting period? So reporting period is the confusion because most of the foreign countries follow calendar period, and for us it will be financial year April to March. So it has clarified that reporting should be based on the calendar year for foreign assets. So calendar year period I need to take. So for financial year 22-23, I need not consider the Jan, Feb, March of 23. I need to report only the period from January 22 till December 22. So the last quarter of previous financial year and the first 3 quarters of the current financial year should be considered as the reporting period for Schedule FA. Now, like I said in the previous pointers, even if the foreign asset is held for a single day, it needs to be reported. Now, I should not be seeing the period from April 22 till March 23. I should be seeing the period for January 22 to December 22. If in this period, if I am holding, then I need to report here. If I am holding any asset after December 22, that is Jan 23 or Feb 23 or March 23, I need not report that in this financial year, but I have to report in the next year's return because that period of Jan 23 to March 23 will be coming relevant to the next assessment year. Okay. So for assessment year 23-24, 1st January 22 to 31st December 22 is required. So from 1st January 23 till 31st March 23 it is not required. So it is in the Schedule FA, the instruction or the heading itself, it is very clearly given. Details of foreign depository accounts held. Details of foreign depository accounts held, or this is A1 table, so this is details of that. Calendar year ending as of 31st December 21. So this is the extract from the previous year's ITR. But if we see the current year ITR, it will show 31st December 2022. Okay, so this is very clearly given in the ITR itself. So that was all about Schedule FA. Now quickly let us jump into the capital gain things, what we need to take care while filling or filing the return by the assessees. So until 2021, we were giving capital gain cost of improvement or cost of acquisition at the lump sum amount. So though I might have acquired the property in one particular year, after a break I would have done certain improvement, and after subsequent couple of years I would have done some more improvement. After a few more years I might have done some more improvement. So basically I have 4 trigger points. One is the cost of acquisition date, and there are 3 different cost of improvements. What used to happen earlier, I used to consolidate all these 3 cost of improvements and I used to give as a one amount in the ITR. But from last year, it has been defined or designed to give information year-wise cost of improvement. Okay. And earlier, one more point is that because there was no breakup, if in case of long-term capital gain, the cost of improvement will be eligible for indexed cost of acquisition. Since there was no breakup, what I used to do, I used to calculate the indexed cost of acquisition as per the applicable CIIs for those 3 different years, and I used to calculate and I used to provide manually the indexed cost of improvement. So now that is not required or that is not possible. I only have to select the year in which the cost of improvement has been done and what is the cost of improvement. Automatically the indexed cost of improvement will be computed by the system, and this is the information that is being changed in terms of disclosure, like cost of improvement and year of improvement needs to be filled. If we see, this is the white area or the fillable area, and the last column, cost of improvement with indexation, is a gray area. This is the derived value or the computed value. I don't have option to edit or fill that field. Now there are reassessment and assessment provisions under section 147 and 148, which is 148A also being coming in through. So we also know that the 50 lakh limit is there to go back up to 3 years and aggregate up to 10 years if it is more than 50 lakhs, isn't it? We all are knowing that. What they say, any expenses or any transfer or any amount which is not disclosed, which is going outside the assessment, aggregated in value more than 50 lakhs, then they can go up to 10 years. So that is the condition that is being prescribed under section 148 for the reassessment limit. Now, this can become one of the point of source for data for them to trigger this section for income escaping assessment if the data filled is not the correct data or the appropriate data. Most of the times, this is considered as a kind of place where they can inflate the cost because documents might not be available, payment details might not be available. For cost of improvement in 1991, what data I can have? So if I have to pay less tax than I will, somebody would have inflated that cost, telling that instead of 10 lakhs, 40 lakhs or 30 lakhs. Now this gap, if I don't have substantial proof or the data to establish that I actually incurred 40 lakhs, then I could get triggered under section 148A for income escaping assessment, and this data now can be considered for that period also, that period of assessment of 10 years. If it is more than 50 lakhs, then they can go. And that is not yearly thing. All the period of 10 years, if it is more than 50 lakhs, they can pick up for this assessment. So we'll have to ensure that adequate supportings are there, adequate source is there for such kind of improvement or acquisition. And we'll have to keep a tab of that while filing the return in the year of sale itself. We have discussed this, that assessee is required to report year on year. So this is one more extract. So cost of acquisition with indexation, total cost of improvement with indexation. So we'll have to give only these 2 dates, 5 lakh in 1920 and 5 lakh in 2021. The index cost of improvement will automatically get calculated by the system. So the next important thing is date of commencement. Earlier this field was not there. Now this date of commencement field is being enabled. This is for business commencement or the operation commencement. Most of the times in big industries or big manufacturing concerns, they take to set up the manufacturing plant or the facility itself for a couple of years, 1 year, 2 year, 3 year. Ideally, they would not have commenced their operations till they actually set up or complete the complete facility setup. Correct? So until then, whatever expenditure is incurred is capital expenditure, ideally. Okay. So now somebody cannot claim that capital expenditure as revenue expenditure and claim the benefit of the reduction in the profits. So they have enabled this field. Prior years, the cases are already going till High Court to debate about what is the commencement date, because there have been cases where people have utilized to report one date as commencement date and claim everything else after that as revenue, but actually the commencement has not happened on that particular date. And now this date will play a critical role because this is a self-declared commencement date. I myself have declared the commencement date, so I cannot go backward and tell that this is not my commencement date. So this has to be considered appropriately, and the income is taxable from the date on which the business is set up. Similarly, all expenditure incurred for the purpose of business and all allowances, deductions under the Income Tax Act are allowable from the date of setting up of the business through the actual commencement of business. maybe at the later point of time. So even though I have incurred expenditure, but I will get those benefit only after the actual commencement of business. Until then I will not be getting. Even in case of the interest cost on the borrowings for setup, that should be capitalized as per the things. So some of the interest expenditure is being claimed as revenue expenditure until the commencement date. So these are the kind of possible issues which are pending before the judicial forums. So to avoid this, they have now given this field to be filled by the assessee itself. Okay, next thing is the transactions in shares, that is 112-day disclosure, which had come a couple of years back, and grandfathering provision which was given, where ISIN details is mandatory and transaction-wise reporting is mandatory, which needs to be given. I think now this has been streamlined. In the initial 1 or 2 years, this was little difficult to have the data. And I think all the service providers have redefined or redesigned their reporting formats to ensure that they have the transaction-wise details in terms of the date of transfer, date of acquisition, and the cost of or the grandfathering FMV value as on 31st January 2018. All of that is being given, and even the ISIN numbers are also given by the reports. Only we'll have to call for the actual report and give that details. Now, if ISIN is not available, then this word can be used in not available. So this has to be used if ISIN is not available, because the validation tool will not validate the return if one of the letters in the ISIN is not correct also. If it is incorrect, then it will not get validated. If it is not available, then this field can be utilized. So last few things, Schedule OI. Schedule OI is the important schedule when it comes to business associates where tax audit is applicable. So where tax audit is applicable means the certain information that gets disallowances or reported under schedule or the tax audit report under various clauses. Now that needs to be specifically reported in ITR also under Schedule OI. Now I would have done a disallowance under section 40A IA, I would have done a disallowance under section 43B, I would have done a disallowance under section 40 capital A7, and I would have reported under respective clauses in tax audit report. Now this report is being filed, and later on I will file the ITR. While filling ITR, I would have consolidated all these three amounts and said that all the disallowances under any other disallowances under ITR in the computation. When I have done this, now the system will map the information, what was the disallowance as per tax audit report and what is the disallowance considered in the ITR. Now there is no disallowance considered under section 43(1), 43B, section 40A7, section 40A IA, nothing is considered here. So the 143(1)A discrepancy notice will come in telling that you have disallowances under the as per the tax audit report there are 3 disallowances, but you don't have those relevant disallowances in the ITR. Now it will become a double disallowance as a deduction not being allowed. So this has to be taken in terms of very seriously to report whether the disallowances as per tax audit report is being reflected in the respective rows in the Schedule OI. So this disclosure entirely comes under Schedule OI, all the relevant information and all the respective disallowances or the adjustments being done in the tax audit will be appropriately taken here. So this needs to be considered very clearly. Even schedule quantitative details most of the times not being filled properly. There is one of the clause 35 itself which gives the in the tax audit report the quantitative details. If it is filled there, it is relevant and appropriate for us to fill in the ITR also. Most of the times this goes unfilled or unnoticed because there is no validation error, because it is not mandatory information and not applicable for all SSCs. If it is only into manufacturing or trading, for them this will be applicable. So in that aspect it is mandatory to fill. So this clause also says that if it is mandatory, if liable for audit under section 44AB. So it is not relevant for me to fill, or it is not applicable for me to fill if I am not liable for audit. So if I am liable for audit, already I would have filled under clause 35 of the tax audit report. The same information I will have to ensure to be filled under the ITR under schedule or part A QD also. So these were some of the pointers that we need to take precaution and attention to ensure that the information goes appropriately, because ITR is the master document. So there is last one point of caution or you should be aware of. There are notices being sent under section 133(6) to the assessees asking these 3 questions. Okay. Give the details of the contact details of the chartered accountant or the tax practitioner who has helped you in filing the ITR. Whether the proof of donation were provided to them, if there is a donation claim. Who has signed the ITR? That means who have filed the ITR. So this information is being collected from the assessees, and it is being seen who has done the mistake or where it has been gone wrong or who has advised how and all of that. So it is very critical for us to have all the information and see what returns are being filed. In case of assessee is authorizing us to file the return, then it is better to have proper representation letter from the assessee in case of digital signature and in case of the information being provided and what is being authorized to file returns on behalf of the assessee. It is better that you collect the representation letter. Now we would have done a lot of research, we would have discussed with a lot of professional friends as to what to be disclosed, what to be considered, what position needs to be taken, and we would have done various analysis, we would have read through a lot of things to ascertain whether it should be taxable, not taxable, how to compute the actual taxable amount. So what we do is, or what I suggest all of you to do is, prepare a document stating that positions taken while filing the ITR. Now if I am taxing dividend, how the position has been taken, what is being considered as exempt, what is not considered as exempt, what expense was allowed, how have I considered 40A IA disallowance, how 43B disallowance is considered. So make pointers for each computation item and put the basis as to how it is derived, how it is assessed, and if there is some reference for your workings, put those workings reference and keep it ready and get it signed from the assessee also, and keep it as a document and see what all informations are coming through from the assessee and put those as a representation letter information and consider that as the document for proof to ensure that the professionals who are filing returns on behalf of assessee are not in trouble. Also, if the return is filed through your system, it is better to take an authorization letter stating and why it is being filed on behalf of them. And if the DSC is being used, also take an authorization for using DSC for that particular purpose and keep this as a documentation to safeguard the interest of the person who is filing the return on behalf of the other person. Now, the moment this information goes to the tax officer, not only the return through which one of the notice or the information provided by that assessee is within. Now he can give a notice to me and ask for information of all the returns that I have filed, and he might probe into all those informations, whether it is appropriate, accurate, and he can issue the proceedings notice for all of those. So this is what I had for today. Any questions? Any pointers? Need any clarification? I am open to answer.
This area was only riskless, now this has also become a risk.
Correct. So these are the precautions that we need to take to ensure that we have lesser risk.
Statement of total income. If you get the signature of assessee, that will not be enough.
So that might be enough, but it is better also to consider the information that has come through him. He might tell, these are my expenditures. This is the cost of acquisition. So let him give that information as and give that specific explanation, like what details that he has, or let him give a declaration, all the relevant supporting documents are there with me and available. So if I have verified, then I can also put that it was made available for verification and that copy can be retained. If it is not at all available with me, but he might tell, I have it in my hometown. Or you might tell I will be able to retrieve it later. On the date of filing, it is not available. So it is better to take a declaration or a representation letter to state that it is available or it is his responsibility to showcase it. Any other pointers to discuss? Okay, thank you all.
We all know about income tax, but there are certain changes which we got to know through Kaushik. Thank you, Kaushik, for that interesting session. And on behalf of the Managing Committee of Bangalore branch of SIRC, I now request CA Sridhar to come over to the dais and hand over the speaker a memento from our end. Thank you one and all for your active participation. Now I sign off for the day. Thank you.